How does variance relate to implied volatility? Have you ever wondered how variance connects to implied volatility in options trading? Understanding this relationship can really help you navigate the world of options. Let's break it down. Variance is a statistical measure that tells us how much a set of data points, like stock prices, spreads out from the average. In simpler terms, it shows how much prices fluctuate over time. When we talk about variance in the context of stock prices, we are looking at how much the price moves around its average value. Now, implied volatility is a bit different. It represents the market's forecast of future volatility, and it is derived from current option prices. Essentially, implied volatility gives us an idea of how much the market expects a stock's price to change in the future. Here's where it gets interesting. Variance is directly related to volatility. In fact, volatility is the standard deviation, which is the square root of variance. So, when we say implied volatility, we are really talking about the market's expectation of the annualized standard deviation of price movements. To visualize this, think of variance as measuring the expected size of price swings squared. Implied volatility, on the other hand, reflects the square root of that expected variance. This means that if traders expect larger price movements, the implied volatility will be higher, indicating greater variance. When traders discuss implied volatility, they are essentially talking about how much they believe the stock price will vary in the future. A higher implied volatility means that traders expect larger price swings. This expectation directly impacts option pricing. As implied volatility rises, options tend to become more expensive. This is because the likelihood of the underlying asset hitting the strike price increases with greater variance. It's also important to note that implied volatility is forward-looking. It is inferred from current option prices, while variance can be calculated from past price data, known as historical variance. Traders often compare implied volatility to historical volatility to gauge market expectations. If implied volatility is significantly higher than historical volatility, it suggests that the market anticipates more price movement than what has occurred in the past. In summary, variance measures price fluctuations, while implied volatility is the market's prediction of the square root of that variance over the life of the option. Understanding how these two concepts relate can help options traders assess risk and price options more accurately. By grasping this connection, you can develop strategies that align with expected market movements, ultimately enhancing your trading experience.